Hi everyone, Adrian here. I'm an investment focused mortgage broker that deals with complex investors on the resi and the commercial side. In this video, we're going to be focusing on the life cycle of a commercial property investor, the different stages of when you're starting out to building out a medium-sized portfolio to a large portfolio. We're going to be talking about the risks associated with commercial and how banks treat you depending on how large you are, how much debt you've got with the bank, how much control that the bank has. All right. So there's three different types of investors in commercial, especially if you've got a lot of residential debt with one particular bank. Now, when we're focusing on number one, that's just your standard investor. I'm still at stage one right now with my super cheap auto and my pet barn, right? You bought one property, you're managing one loan, you're at one LVR, you've got one lot of leases. So for mine, it's two properties, super cheap auto and pet barn, it's a 5 and a 7 year lease. And then you've got different banks that do different things. Some do yearly checks where they check the valuation online. They check that the lease is in place and what the rental income is. And then they go ahead and they reassess your borrowing power based on the loan size that you got. So I've got one client right now that got 3 rate increases in the last 12 months. And their loan size has gone down 60 grand because they're on a lease doc loan instead of a full doc loan. So we're actually going to add that in right now. Let's come over here. I can't add it in. That's all right. So you've got more risk associated when you're looking at a deal and it's a lease doc loan compared to a full doc loan. Why is that? Well, if you go ahead and you leverage up at 65 or 70% LVR on a lease doc loan, and then you don't have cash buffers in place, or you've mismanaged your first 12 to 24 months of holding the property and you haven't built up your cash flow, or you've gone and utilized it on a holiday, or you don't have multiple residential properties behind you, or a lot of extra income from your job to de-risk yourself in that first 1, 2, or 3 years that you hold the property, then, what if a bank came and knocked on your door and suddenly your loan size got dropped by 60 grand? And then you've got 4 weeks to go ahead and sort that out. Or if you don't, they'll call in the loan and start forcing the sale of the property or put you into default. These kind of situations happen. So you've got more risk associated with the transaction if you're at a higher LVR and you're on a lease doc loan. And obviously, if you've got a tenant that is there for the long term and you've got longer leases, then it is easier to manage. It is easier to manage if you're a full doc borrower where you're using your income from your job to juice up the borrowing power to give you a buffer in the borrowing power. If you're on a higher LVR, you've got a lower risk if the first 2 years that you hold the property, all you do is stack up your cash. So then by the time the lease event occurs, even if the tenant leaves, or let's say the bank valuation comes in short or the borrowing power drops, then you've got buffers, right? You've got a cash buffer there. Some clients, they've got 6 to 8 properties and they know that 6 of them have almost doubled. So they could just go and sell 1 or 2 of the properties and clear all the debt. So they're going to be de-risked into their first transaction. So the goal with commercial is getting bigger, because the bigger you get, the lower the risk you are to the bank, the better things that you get out of the bank, the more controls that the bank has, and the better pricing that you get long term and better products that you get long term. All right, because this is a game that you can play until you're 80. Lease doc loans allow you to continue going. They isolate the debt in things like a corporate trust or a company, right, away from your residential portfolio. And then lease stock loans only focus on the property. So they'll focus on the deposit and costs and the lease and the rental yield. That's it. So if the deal internally services by itself, they won't go looking at the rest of your portfolio. This is how people get much larger. This is how people can stop working and not need a job to get your next loan. All right, but with that benefit, you get extra costs and extra risks which you need to manage. All right, so not a lot of commercial people in the commercial property space or the lending space speak about these things. So then also, we've got to talk a little bit about price point. So you have more risk if you are in the smaller category to the medium to the large category, because the leases are longer. You could be getting a deposit bond, right? Some get 2 to 4 month deposit bonds, some don't. Some national tenants don't put a deposit bond down, but they're national tenants wanting longer leases. And some businesses, like let's say medical or my big box retail, my super cheap auto, my pet barn, they've put a fit out into that location. Some of those fit outs cost 100, 200, 300 grand. They do not want to leave. They've got a large cost in moving that to another premise. Also, if you get into national tenants and they've got franchise agreements, the agreements actually force them to uptick or spruce up in between their leases and in between their franchise agreements. So they have to keep it up to a certain standard. So a lot of capex that a normal person would have on themselves, if you get certain types of tenants, a lot of that capex is going to go on top of the tenant, not on you, which again benefits you and increases the value. So these are the things you need to talk about, because in residential, the larger you're getting, or you're getting, 3, 5 or 7 investment properties that are cheaper, they cover themselves. But then if you start getting into the 800 grand to 1.2 mil space, you've got a hell of a lot more negative gearing and risk and negative cash flow that you've got to manage. So in commercial, if you start getting out of cattle class, which is probably under 800 grand, where there's 10 times the amount of buyers than there are quality stock, you can definitely find good quality businesses in those areas with your buyer's agent, right? But you just got to be a lot more patient and a lot more picky on the tenant types and where it is. You don't want to be caught out in mining towns, in small regional, in areas like the small postage stamp kind of businesses, those coffee shops that are 5 square meters, where if the tenant leaves, the premise is too small and it's not as versatile. All right, you want to avoid that kind of stuff, because once your tenant leaves, the vacancy goes through the roof. I mean, even if you're talking about office space in regional goes pretty well. And office space in, the outskirts of main cities goes really well. I'll give you an example. So I'm from South Sydney, Sutherland Shire. The office space in Cronulla, it is so tightly held, it's not funny. Like the vacancy is like 1%. All right. But if you go and get office space in main cities where no one's going to work, you've got 15+% vacancy rates. So if your tenant leaves, you might have 6, 12, 18 months worth of vacancy. And if you don't want that, you better be giving a huge incentive to your tenant, and incentives eat into your profit margins, right? You might be having to give 6 to 12 months worth of free rent. You might have to do a spruce up and go halves in with your tenant with air cons and things like that. So these things are the things that you need to manage. And once you start getting into the 2, 3, 4 and 5 mil categories, you're getting too big for a retail investor where they can't afford the deposit and costs, and you're too small for an insto investor, a REIT investor, really large business owners or super funds, because a lot of the time they're not going to look at anything under 10 mil, right? It doesn't move the needle from them. So you're in this kind of sweet spot where you're not having to compete with a lot of other people, so you get much better deals. My particular property was not on market. It was off market completely. I didn't have to compete with anyone, right? So these are the things you need to talk about, because there's a hell of a lot of things that you need to manage in item 1, and then you progress to item 2. What is item 2 and what type of client is in the portfolio size of item 2? So even me that had 9 resi investment properties, I'm not on stage 2 yet. Stage 2 is when you've got maybe 2, 3 or 4 commercial properties at different sizes. You've got a larger amount of debt associated with your properties. Most likely the banks are starting to ask for more caveats, more GSAs, more control. And if you've got a trading business, they want that business over to you. So with residential, you're trained to have, a lot of stuff in separate banks. The larger you get in commercial, the more likely you are to have everything in one bank. But also the more control you give to a bank, the better pricing you get, the more things that you get when they do the checks. So they don't see you as just holding one property, one valuation, one lease check, one borrowing power check, where if one property goes down, the others might go back up, to offset it. They look at you more from a medium-sized portfolio standpoint than getting just one property where, they could come calling for extra collateral, right? And then also you start getting access to different kinds of products, because if you start getting over about 4 to 5 mil worth of debt, you start going into the private bank space. Let's just be honest. You got different bankers, right? You got one at 1.5 mil delegation, then you've got one at 5 mil delegation, and then you've got the one above that. Now, the one above that is normally the lower end of the private bank space. Also, your health bankers, they're around there, and also your medium to larger size small business, right? So you're starting to have more associated products, right? You might use the wealth arm of the bank. You might start using small business banking. You might have a logistics business with a little bit of import-export. So you start using some of the associated currencies and FX products of the bank. So they start seeing you more from a diversified point of view, right? So that's the second line, and you start getting more benefits, you start getting sharper interest rates. They start not being as stringent on you with your LVRs. But also, once you get to number 2 and stage 2, where you're on 2, 3, 4, maybe even 5 properties, probably only 4, you're starting to ask questions like, do I need 70% LVR anymore? Because if you go and speak with anyone that's built a larger investment portfolio with commercial, a lot of them are managing their LVRs around 40 to 50% LVR. Like, use me as an example. I'm on 51% LVR at the moment. I think my debt's sitting at about 1.96 to 1.97 mil at the moment. Now, I've already made my 2 to 2.5 mil on my resi side when I sold my 9 resi properties. I don't need huge LVRs anymore because I'm age 39, and if I compound what I've got and I don't blow up, it turns into a very big figure, right? So over the next kind of, let's say, 2 to 4 years, if the rates drop back down to 0, I may very well just fix my 2.45 mil worth of debt at 65% LVR, and then suddenly I'm on a rate range of 2.7 to maybe 3.2%, depending on if I want interest only or principal and interest. And then I'll use that kind of 3 to 4 year period of really low rates, because I'll probably take like a 3-year fix, maybe even 4, depending on how good the rate range is. And then I'll use that 4-year period to really go gangbusters, where I might go and buy, a property every 10 to 12 months, and I'll keep every property sitting at 40 to 50% LVR. So over a 3 to 4 year period, I might be able to get up to 4, 5 or 6 commercial properties, but I do it in a much lower LVR way, right? And I'm not blowing up. So one valuation can't hit me, one borrowing power check can't hit me. They start looking at you more from a diversified point of view. You start getting better rate ranges as well. So these are the kind of things that we need to talk about. Now, then you start getting into stage 3 where you've got a large amount of debt. And some people might go from stage 2 to 3 very differently. So I'll give you an example. Let's say I go and every 10 months for a 5-year period, I go out and I buy a 1 to 1.2 mil property, right? And then I'm sitting at 40 to 50% LVR across everything. Those smaller properties with the amount of people that are buying in those categories, you tend to get a little bit more economic growth out of the properties. So it may be a stage where I actually clear a very big portion of that 4 to 5 to 6 smaller properties, and then I go and buy a trophy asset like I've done with my other one, right? My super cheap auto and my pet barn, because I may want to go and buy like another 4, 5 or 6 mil property. And then that gets me into 2 larger tenancies, larger properties. And I'm not having to manage as many tenants, right? And I've got lower risk because they're longer leases, national businesses for me to manage, right? So that's something that I may actually do, and then I'd go and buy that one and then potentially one more on top of that. So I might, by the time I get to stage 3, I might have 3 key assets sitting at anywhere. By that stage, my super cheap auto and my pet barn might be worth 5.2 to 6.2 mil at the end of the 5 to 7 year leases, and then I'd go and find 2 more. So then suddenly I'm sitting on 10 to 15 mil worth of assets sitting on a 40% LVR that's cash flowing heavy. So these are the kind of things that we need to be talking about. When you're in stage 3, you're in private bank, you're a larger client, you're getting better pricing, they're looking at you from a portfolio standpoint, not an individual property standpoint. One property doesn't impact everything because you're managing your LVRs lower. And then these are the things that get you bigger. Like, there are some products in the private bank space where you are getting a portfolio LVR limit. They do 12-month valuations. You give all the caveats, the director guarantees and the GSAs to the bank. You're in one bank, but you get a whole lot of benefits where they'll allow you to continue buying resi and commercial, and they'll treat you more like a wholesale client where you're not having to upload a huge amount of documentation on a per deal basis. They might get you to update it every 12 months, but these are the things that you get when you get bigger and bigger and bigger compared to where you are on stage 1 where a lot of clients are. So hopefully these kind of videos give you a whole lot of context on, risks, managing what you do at the different stages. If you need any help, I deal with a lot of complex commercial investors and investors on the resi side. I'll put my email in the link. Please go ahead and send me a scenario. More than happy to help. You need to be dealing with a commercial broker, especially if you've got a large resi portfolio that understands the commercial and the resi side, which is what we do every day of the week. So hopefully these videos help you understand these kind of concepts. We'll see you on the next one.